Hello, today we are going to start the accounting principles and conventions. Accounting principles can be subdivided into two categories. These categories are accounting concepts and accounting conventions. Now, the term concept means that something which denotes to the postulates or necessary conditions and assumptions which are necessary for the accounting purpose. The term convention is used to signify the customs and traditions as guided to the presentation of accounting standards. These are the background based on which the accounting standards are to be used. Now, the accounting principles are some of the most important accounting principles are like these: uh, business entity concept, money measurement concept, cost concept, going concern concept, dual aspect concept, realization concept, accounting period concept. So let us start with the first one, which is the business entity concept. But before that, let me also go through the accounting principles. Accounting conventions, the part of the accounting principles are like these: conventions of consistency, conventions of disclosure, conventions of conservation. The first one, the accounting concepts. The term concept is used to connote accounting postulates, that is, necessary assumptions and conditions on which the accounting is based. Now, business entity concept, one of the most important concept in accounting and also the one which lays down the very basic principle of recording any financial transaction. The first thing is that business is treated separate entity from its owners. Owners and business are considered as two separate entities. That is, the accounting is going to record the transactions of the business and not that of the personal transactions of the owners. So that even whatever the owner withdraws from the business is recorded separately, so that the gains and losses or the measurement of the efficiency of the business is captured and not that of the personal uh, effects or personal transactions of the owners. So therefore, business entity concept lays the basic foundation of the accounting. All the transactions of the business are recorded in the books of the business from the point of view of the business as an entity, and even the owner is treated as a creditor to the extent of his or her capital. In fact, even the capital earns certain interest, and similarly in certain types of organization, the whatever the owner withdraws from the business, that is also to be charged. That is, the owner is charged an interest on that also. Now, therefore, the most important aspect of this concept is the separation of the ownership of the business and the lending or the funding of that business by the very first or the main financier of the business, the owner, whose ownership into that is known into a business is known as equity. The next most important concept is that of the money measurement concept. All the financial transactions, all the transaction events which can be recorded in terms of money are to be captured. Anything which we cannot convert into monetary terms cannot be recorded. Like for example, it may be the honesty of the customers, of the workers, or the uh, general managers of the organization, or it's the hard work and talent of the people who work for the organization. So these cannot be recorded. Whatever is to be recorded has to be in terms of the monetary aspect, that everything can be converted into a quantified amount, money. Next most important concept is that of the cost concept. The transactions are entered into the books of accounts at the amount actually involved. Suppose a company has purchased a vehicle for 3,50,000, for which this 3,50,000 is the value, but it has uh, uh, the amount which has been paid is different. So actually you have to see that at what amount the uh, money has been paid or the value has been paid. A very different thing from the actual value of the asset. Now asset may be more or less. For example, here we have taken a example of a vehicle. Suppose a company purchases a vehicle of 3,50,000, the real value of which is 2 lakh. So the company has benefited from the transaction, but it will record what has been paid, what transaction has been considered as the main transaction, irrespective of whatever the value may be, because we are not going to fluctuate the value of the asset whenever the market changes the value of that particular asset. So the cost concept is very clear about capturing that amount which has been paid, even if it has been paid on the credit basis. So the cost concept therefore is one of the most important concept. Next concept is that of the going concern concept. Going concern concept is also a very important concept, that all the transactions which are being recorded in the accounting are recorded from the point of view that the business will stay forever, and therefore it's not like a project which is to be started and which is to be end at a particular point of time. Rather, it is something which is considered to be perpetual, that it will continue in existence for an infinite time. Therefore, the going concern concept is a concept because of which the other concepts are workable, like the cost concept, that certain costs can be such which can be appropriated over a period of time, like the advertisement cost. The another very important aspect based on which we are going to capture the transaction value for the business is the dual aspect concept. Now, dual aspect concept is something which talks about the two aspects, that is, receiving benefit by one party and giving benefit to the other party. The principle is the core of accountancy. For example, the proprietor of the business starts his business with cash 1 lakh, car of 50,000 and building of 30,000. Then this fact is recorded at two places. The first one is the assets, that whatever the assets have been now given to the business by the businessman, that what are these assets, and these assets will therefore be captured on the asset side. On the liability side, what will be captured is that how they have been financed, from whom it has been financed. It has been financed by the owner. So it is the owner's investment into the business which is sum totaled and given on the liability side. So the 1 lakh rupees cash, 50,000 rupees of car, 30,000 rupees of buildings, this come out to be 1 lakh 80,000, which will be shown as equity capital of the owner's money which he has invested in the business. So the two sides then therefore match. This matching can also be converted therefore into a accounting equation, the basic accounting equation, which helps you understand and solve some of the uh, even very complex problems for accounting. The very basic uh, concept or equation is the capital plus liability is equal to asset. Now, suppose for example, the business has purchased a car of 1 lakh rupees, but this car has been financed 10,000 rupees from the pocket of the owner and 90,000 rupees of cash has been received by the SBI bank loan. Therefore, the balance sheet will show on the asset side the full value of the asset, the car, which is of 1 lakh rupees, and on the left hand side the liability, it will show 10,000 rupees of equity, the owner's amount, the capital, and 90,000 rupees as SBI loan. Hence the both sides will match. If you see, if I deduct from 1 lakh the asset value, the liability, you get capital. Similarly, if you add capital and liability, 10,000 and 90,000, it equals the asset. Or it can also be said, like I have just said, that capital is equal to asset minus liability. So we have to remember this concept, because this is something which will help us in all the transactions of of our accounting, and especially we will see that how it gets converted into the accounting standards for your own country, accounting standards of India, and the accounting international accounting standards. So we'll see how that gets converted later on, based on these very simple yet complex concepts. The realization concept. Accounting is a historical record of transactions. Whatever has been done at a particular point of time, whatever has been paid for the assets, are recorded at that cost. That becomes the cost concept. It captures that particular amount. It records what has happened. It does not anticipate events. That in case of the inflationary conditions, the assets value will go up or don't go down. It is not going to record those changes. It is going to record that at what cost any particular asset has been purchased, or what has been the liability which came up at a particular point of time and therefore captured at that point of time. It is not going to change in the coming events. Even if this change has to be done, it is done in certain other accounts, which does not affect those assets and liability at that point of time. So accounting is something which is based on historical records. No, it does not anticipate events. As I have said, this is of a great importance in preventing business firms from inflating their profits by recording sales and income that are likely to accrue. This is again a very important aspect, because some of the, for example, project finance. A company has taken a project that it will establish a steel manufacturing company for you, a plant for you, which will take 2 years to complete. And they have given you a charge that this much amount will charge for that. So suppose 2 crore rupees. So these 2 crore rupees will be invested in the next 2 years. That particular company cannot show that out of these 2 crores, we have the actual expense of 180 lakhs, and therefore 20 lakhs is the profit, when at the time of getting this contract. This will vitiate or will hamper the actual accounting policies. The realization will be considered only when substantially something has already been done, by what we can say that it is a sale. Therefore, this concept helps the accountants to understand that what is the profit which has been earned. It does not include the anticipated profit. Okay. Although there is another aspect to it, that if profits cannot be anticipated, the future profits cannot be anticipated and written and reported in the profit, what about the expense? Can they also be anticipated, or they are not to be anticipated? We'll see that how the accounting treats with that kind of convention, or with that kind of item also. The accounting period concept is another important concept, which uh, gives a very basic framework to the accounting, that the accounting is to be prepared for a particular period of time. Okay. Now that period of time you cannot keep on changing. So suppose first of all you make the account for 6 months. Thereafter you have recorded you have prepared the accounts for 1.5 years. Thereafter, for say suppose 3 months, if you are recording the profit and loss balance sheet on this basis, it will become very difficult not only to uh, understand that what has been the growth, or how the growth has not happened, or it has been stagnant, or you cannot match that what exactly is the earning for you for a particular period of time. So therefore, whatever you have decided at one point of time, the accounting period should be kept for that only. It should not be changed. The let me so you can go through this slide and you can understand that how the accounting period concept is a very important concept. Strictly speaking, the net income can be measured by comparing assets of the business existing at the time of its liquidation. But as the life of the business is assumed to be infinite, the measurement of income according to the above concept is not possible. So, a 12-month period is normally adopted for this purpose. This time interval is called accounting period. Now, another very important aspect is that when we say conventions, as I have said earlier, that what is a convention? Term convention is that uh, it signifies the tradition or customs which are prevalent uh, in a particular area or a country which has an impact on the financial recording of the transactions. They have an impact on the accounting of that particular area. So, accounting conventions does take into account that what are the locational or area wise or regional aspects. Okay. Although this is what will be talked about later on in the international accounting, where we will try to see that how these divergence, these local and domestic related interpretation of the accounting can change the very accounting standards. So, the first convention of the consistency, a very important one. Let me deliberate upon it. That in order to enable the management to draw important conclusion regarding the working of the company for a few years, it is essential that accounting practices and methods remain unchanged from one accounting period to another. The comparison of one accounting period with that of the another is possible only when the convention of consistency is followed. This is, let me explain it further, that it means that, say suppose you are following a one particular method of valuing your inventory. Say suppose it is LIFO method, last in first out method. In the next accounting period, you change the method. You change it from LIFO to FIFO, first in first out. Or let us suppose that in the first year you had the accounting uh, of the depreciation based on a straight line method, 20%. So, suppose you have purchased machinery of 100 crores and the depreciation is that of 20%, and for the first year you have charged the depreciation of 20 crores. In the next year the accounting is changed, the method is changed, and there you say that now it will be the written down method and it is going to be now 30% of the balance. So now the asset which was of 100 crores has been reduced by 20 crores, it is now 80 crores, and of that 30% is being charged as the depreciation, that is 24 crores. So last year it was 20 crores, now it is 24 crores. This cannot be compared because at both the times the not only the percentage is different but the method is also different. Now this is not acceptable in account because that is going to change your profits and losses and its communication in a big manner. Therefore, the convention of a consistency says that you have to keep, and you should ideally keep, the methods at same. Now, it does not mean that the accountant does not have the flexibility to change it later on. It can be changed, but that has to be changed with a particular procedure which is to be communicated, the impact of which is to be measured, and that also is to be communicated, something which international standards and the accounting standards are working upon and has made very, very clear for the accountants. So, convention of consistency helps us to understand and to report something which we can compare, something which we can match, something which can be used by our managers, by our top management to strategize for or to make policies or to evaluate their successes and failures. If we do not measure with the same yardstick, it is very difficult to understand that whether we are progressing or not, and if we are, then at what rate. Similarly, we cannot plan for future looking at the our historical records if they are not consistent. Next convention is that of the disclosure. This principle implies that accounts must be honestly prepared and all material information must be disclosed therein. The concept of balance sheet, profit and loss accounts are prescribed by the law. These are designed to make disclosures of all material facts compulsory. That means that whatever is going to have an impact on your business, that should be reported. That should form the part of your balance sheet profit and loss. Now, that does not mean that we have to record very trivial matters in it. Say, suppose in a very big business, you talk about a small collection or very small expenses. It does not mean that, but it means that all those events and transactions which are going to have a major impact or impact on the your profit and loss balance sheet should be recorded, and those should be therefore disclosed. That means, here I'll again quote from my previous slide that, as I had said earlier, that if you have changed the accounting system, how it has going to impact or it has impacted your profit, that you will have to report. So, good reporting system will definitely disclose all those aspects which are going to have an impact on your profit and loss or balance sheet. The convention of conservatism, conservation is again a very important concept. This concept is the one with the help of which many of the decisions can be taken by the accountants. Financial statements are always drawn upon on rather a conservative basis, that is, showing a position better than what it is not permitted. It is also not proper to show a position worse than what it is. In the other words, secret reserves are not permitted. That means, let me clarify that uh, this concept talks about that uh, if whatever are the expenses, they have to be reported to its fullest. You cannot overstate them or understate them. If you understate them, you are increasing the profit. Because what is profit? Profit is sales minus the expenses. If you have understated the expenses, this profit will increase. If you have overstated it, then your profit will decrease. So, this convention calls upon to disclose and to record the transactions and financial matters in a manner that whatever is claimed and communicated is actual. You do not over or understate it. Now, although it is very difficult to achieve it, if you look at the companies, the examples, you will find that there had been so many companies who which have overstated or understated the expenses. Like for example, at one point of time, Microsoft has been doing this. That it has been reported by many of the researchers that they think that uh, the company had been reporting its expenses as less, and therefore uh, it had an impact on the profit. While the other researchers were of the view that those expenses are actually much higher. So, the deliberate issue of being over conservative with the conservative concept can also be wrong, and not being conservative is also wrong. Okay. So, it talks about relating what is to be related. Now, functions of accounting. What are the functions of accounting? What does it do? The very first function of accounting is that it it is something which keeps a very systematic record. Another is that protecting the proprietaries of the business. Third is communicating the results. What has happened? Are we in profit? Are we in losses? Are we going up or we are going down? Meeting legal requirements, because the laws of any country also demand that what has happened with the organizational resources is to be reported. Whether these resources which are at the disposal with the managers, they have been adequately used, or what they claim to be used should be reported. That means, is the profit okay, or it had to be more or less. So, therefore, the legal requirements also require that the accounts are properly maintained and communicated. After all, government is one of the stakeholders. They do take their taxes based on these reporting. So therefore, I may summarize the whole thing as that what you should remember is that these concepts and conventions are to be remembered by each and every student of finance, uh, very particularly, because this is something which helps you at the time of confusions or at times of recording those transactions which you think are not very clear transactions. At those at times of these ambiguity and confusion, these concepts and conventions will help you understand and take the correct decision. These are therefore business entity concept, a very important concept which has a bearing on your financial transaction, money measurement concept, cost concept, going concern concept, dual aspect concept, realization concept, and accounting period concept. Thanks.